Hello, I'm audible, ma'am.
Yeah.
Good morning, everyone. To all the participants, myself Pratap from National Center for Financial Education. I welcome all the participants to the fourth capacity building program that we are conducting in coordination with the financial sector regulators as a part of Financial Literacy Week. And today we have two speakers, Ms. Manju Bhalla, General Manager from PFRDA, and Mr. Nitin Hansda, Assistant Manager from PFRDA, to speak on the theme Good Financial Behavior for Smart Retirement. Now, let me introduce the speakers for all the participants. Ms. Manju Bhalla, ma'am, is working as a General Manager with PFRDA, and she has over a decade of experience in regulatory framework. She holds a professional qualifications of cost and works accountant, and she is a qualified company secretary. Is currently heading the Department of Financial Literacy Training, Annual Report, FSDC, and Internal Regulatory Matters of the Authority. We welcome you, ma'am.
Thank you
And
so much.
Hansda, who is currently working as an assistant manager at PFRDA. Prior to joining PFRDA, he has also worked with State Bank of India, the more than 3.5 years of experience. Currently, he is handling the financial literacy training, SCPF, and help desk at National Pension Scheme and Atal Pension Yojana Department and PFRDA. Now, I'll hand over the mic to the speakers, ma'am.
Thank you so much, Pratapji. A very good morning to all of you. As we all know that Financial Literacy Week is being observed by NCFE during February 13 to 17, 2023 on the theme of Good Financial Behavior Your Saviour. सही वित्तीय बर्ताव करे आपका बचाव. Today, as a part of this capacity building program, I, Manju Bhalla, General Manager, Pension Fund Regulatory and Development Authority, along with my colleague, Shri Nitin Hansda, will be talking about good financial behavior for smart retirement. Smart सेवानिवृत्ति के लिए सही वित्तीय बर्ताव. The overview of the presentation is like that. The part A would be covering concept of financial behavior, savings, retirements, pension and retirement planning. Part B would be covering National Pension System and Atal Pension Yojana. And then we would be having a question and answer session in part C at the end of the presentation. What is financial behavior? One has to first understand the concept of financial behavior. Financial behavior is one which supports financial well-being. It's a state wherein a person can fully meet current and ongoing financial obligations, can feel secure in their financial future, and is able to make choices that allow enjoyment of life. There are 4 specific behaviors that are described that one needs to exhibit in order to achieve financial well-being. First one is that a person needs to manage their money. If you simply put it, one needs to manage what comes in, what goes out. A person seeking to achieve financial well-being needs to live within their means. जैसा हम हिंदी में कहते हैं कि जितना चादर है उतना ही पांव पसारिए. The second behavior that one needs to exhibit is to do their research and seek knowledge about their financial decision. One can talk to their family members for this. One can talk to their spouse. We may seek the wisdom of our friend or a co-worker. And if any technical decision is involved, we may consult some expert on this. We can attend a workshop to learn more. Third behavior that supports financial well-being is planning and goal setting. People who plan their spending often have short-term as well as long-term financial goals that they try to achieve with this planning and goal setting. The fourth behavior that supports financial well-being is simply follow through. All the managing, knowledge, and planning will not result in financial well-being unless the person follow through with these behaviors. Is my financial behavior good or bad? Please ask yourself few questions. Am I spending more than what is required? Am I not saving on a regular basis? Am I not planning for my retirement? Answer to these questions will decide whether your financial behavior is good or bad. The good financial behavior is one where you live within your means. And the bad financial behavior is you're spending more money than you earn, neglecting to start an emergency fund, and you're not saving for retirement. Now it's your choice whether you want to have a good financial behavior or a bad financial behavior. It's your choice because, after all, it's your life. Savings and investments. Savings, as we all know, from the early childhood, we used to, told by our parents, they used to give us a piggy bank sort of thing. So whatever, a few coins or few notes we get as a pocket money, or we used to get for spending, they try to build a habit of, saving a small amount out of that, so that the person or the child should have an habit, develop an habit of saving the money in the early childhood. And piggy bank is a live example for that. And child feel good about when they collect a lot of money into that, and they can plan, they want to buy a bicycle out of that, they want to buy a good dress out of that, they want to buy some musical instrument out of that. So this habit makes them aware of what is saving and what is investment. So saving, you can do in the form of bank saving accounts, as well as you can have a fixed deposit in a bank. Once you save the money, as we know, saving is setting aside money you don't want to spend now. Then once you have a surplus money, do you have to invest the same in form of some house? You have to buy some retirement plans. You can invest in some stocks, some mutual funds. So through saving money, your money is kept safe and the money is easily available when you actually need it. By investing early over a time, your money grows in value, benefiting from the magic of compounding. Remember that investing early along with compound interest can result in higher investment amount versus a late investment start. So why saving is required? Your saving offers you a peace of mind. It gives you a better future. It provides your children education as well as marriage, which are big, big expenditure for any household. It gives your family a social security post life, working life. When you are not working somewhere, you don't have any regular employment. So saving in a nutshell give you secure financial future. So the moral here is we should not save what is left after spending, but we should spend what is left after saving. So saving is a priority over your spendings. One has to save for the different phases of life. When you are studying, you have to save for your higher studies. You want to get into some job, you want to start a family, your responsibilities will be there, you're going to have some kids, their education and all, so you need money for that. Once you have a family, everybody wants to have their own house, so buying a house a big project in anybody's life, and it needs a lot of funds to be make available for them. So early you start saving for that, you will be quite comfortable in buying your house. You have the situation when you have such a good earning in your life. So when you have a major chunk of earning in, you put your major chunk of earning in savings, you can have a comfortable life ahead. And that saving will help you to lead your retired life in a comfortable manner. When the saving is mostly required, save now or save later? One has to think about it. We will show you a example for this, like when you should start planning for retirement. There are three cases that have been presented here: Mr. Invest Now, Mr. Catch Up, and Mr. Wait Longer. Mr. Invest Now start investing at the age of 25, Mr. Catch Up at the age of 35, and Mr. Wait Longer at the age of 45. All the three makes a monthly investment of 2,000 per month. The time horizon for investment for Mr. Invest is 35 years, for Mr. Catch Up is 25 years, and for Mr. Wait Longer is 15 years, considering the 60 years of age as a superannuation. So the total contribution made by Mr. Invest at the rate of 2,000 per month for 35 years will amount to 8.4 lakh, the amount he has invested. Mr. Catch Up will put 6 lakh of his contribution. whereas Mr. Wait Longer will put 3.6 lakh of the total contribution because the time horizon is very less for him. So you can very well see the difference in the retirement corpus the three of them are making. Mr. Invest Now is having a retirement corpus of 59.2 lakhs. As compared to this, Mr. Catchup is having a 33.2 lakh of rupees as a retirement corpus. And Mr. Wait Longer is the least amount he is saving for his retirement corpus, that is 7.6 lakhs rupees. So you can very well see that the investing early will lead to bigger retirement corpus as you get the benefit of time as well. The more time you are investing, the bigger corpus you are creating. Why planning for retirement is important or is an area of concern nowadays? See, India is a young country and expected to remain young for the next couple of decades. As per Census 2011, percentage of population under the age of 25 years is around 50%, and percentage of population below the age of 60 years is around 92%, and share of elderly in the total population is around 8%. So proportion of people aged above 60 years in the total population is presented as this bar graph. So by 2050, the proportion of elderly, that is people aging above 60 years, is likely to increase almost 3 times as compared to the year 2000, which was 7% in 2000, and it is expected to reach 19% in 2050. Between 2020 and 2050, if you see, it raises from 10% to 19%. That is that the old to young ratio would be double in the coming 30 years. In this connection, it is also to be noted that in India, old age dependency ratio is continuously rising, which was 122 in 1991, 131 in 2001, and 142 in 2011. For your convenience, I would like to explain that the old age dependency ratio is a ratio of the number of elderly people at an age when they are not generally economically inactive, that is age 65 years and above, as compared to the number of people of working age, that is 15 to 64 years. As in India, ODR, old age dependency ratio, is continuously rising. This leads to higher responsibility on the working age population to support the aged population. So this is the matter of concern which the country is facing nowadays. So what exactly is retirement? When we hear the word retirement, what comes in our mind? Instantly, like relaxation, 7 days weekend, sleeping till noon, living on the beach, having a vacation at your choice. A happy retirement is no longer about sitting and watching rest of the world. Retirement is all about embarking on your life's greatest adventures. Today people think of retirement as a time when they can finally put their feet up and enjoy the life without any stress or responsibility. So it's a time when your life, when you no longer need to work and you want to live comfortably and can rely on your savings or passive form of income to fund your lifestyle. The stage of life when the investment corpus generate the income needed for life is called retirement. If you have not planned for your finances to lead a comfortable life post retirement, the promise of golden year can quickly be fade away. What is pension and why there is a need of old age pension security? If we see at the total today's economic scenario or today's social scenario also, the population is aging with each passing day. There is decline in the fertility rate. People are not having so many kids. Earlier, our grandparents and their ancestors, they used to have 10 kids. Now it's a one kid kind of thing. So there is a decline in the fertility rate. India's life expectancy ratio has always been on the rise because of the good medical condition, because of the good health facilities available, better hygiene that is now available. And there is a decline in the intergenerational support within the families. So, because of all these reasons, pension is required because pension provides people with a monthly income after retirement, which serve as a regular income without which life might become difficult. They are not depending on anybody else if they have their sufficient amount of pension to sustain their life. Why we all need retirement planning? Since we know that there is a potential of decreased income earning potential with the age. As we grow old, our earning capacities decrease because of energy level, you can say, because of the technological advancement, like the younger generation who is coming, they are more technologically advanced. Like there are a number of reasons for that. We also expect to live longer because of the good medical conditions, because of good health services available, because of the good hygiene level which are being maintained in the society right now. There is a possibility that we might not be living with our children as we grow old, because nuclear families are now very common in our social scenario. So once the kids grow up, they want to lead their life independently. It's quite possible that they are not staying with their old parents, and old parents has to manage their affairs on their own. And there is no such sufficient government support sponsored social security scheme available, which alone can handle your all expenditures and all your needs in the post retirement life. As we grow old, there is a need to put money aside for your health care also, because as you become old, you become a little physically lean. You need more attention on a medical front. You have to have a regular health checkups. You have to visit your medical consultants very frequently, which is not the case when you are young. Moreover, there is a rising cost of living expenses every day for your daily groceries, for your clothes, for your rents. So everything has an inflation effect, and the cost of living is increasing and keeps on increasing in the coming years also. So these factors are required and leads to the need for retirement planning. When we can say that the financial readiness to retire, there are the few variables for retirement planning. Lifespan, which is highly unpredictable. Nobody knows whether someone will die at the age of 40 or 80 or 100 or 120. So as long as the length, the long you live, the more money you need to make your life, livable. Health is quite unpredictable. You never know how much money you need in the old age to suddenly have some operation or some medical procedure done, or any health checkup, any consultation you have to need. So you need money for that. Support system, as we discussed, joint families are big no-no nowadays, and we need to have our own saving to live our life. Lifestyle, what kind of lifestyle we want to have a post retirement, that is totally a personal choice which we want to lead our life. Retirement corpus, it is a controllable amount which we can plan with when we can start early for investing for our retirement product. So start retirement planning today so that you can make a big corpus that can help you generate income in a big amount so that you can lead your life comfortably. You can only control what you do today or try to ensure a happy post retirement life. So whatever steps we can do as of now to make our life comfortable in future, say when we turn up 60 and all, so those steps should be taken up immediately. That will help us in the long run. Now we can say, who needs a retirement planning? Is there any section of the society who don't need a retirement planning? No. Anybody in the society, irrespective of the gender, male or female, irrespective of the working class, like if it's a self-employed or a salaried person or a professional, doctor, chartered accountant, or a daily laborer or a contractual staff, anybody who is working, who is young, going to get old and going to get out of the working life also one day. Had it been a 60 years of age of superannuation, had it been a 62 or 65 or 70 in some cases. But the day will come when you will retire. And then there will be no regular flow of income. For that day, you have to plan for your retirement. So it doesn't matter whether the individual earning is high or belongs to a low income group. Everyone needs to plan for this stage of life. Factors to be considered for retirement planning. Retirement age. At what age you are going to retire? In some cases, it has been say 60, 62, 65. Some people work till the age of 70 if their health allows or the circumstances allow. Longevity, it's a long duration of the individual life, the amount of life that someone lives. So if you are living, say if you are superannuating at the age of 60 and you are going to live up to 80 years of age, which is quite normal, so you have 20 years of life that has to be spent on your own funds. In case you go beyond that, you live by 90 years, you have to, support yourself for another 30 years. If God is kind enough and you live up to the 100 years, then my dear friends, you have to fulfill your needs for another 40 years. So do you have that much money with you? If you don't have, you have to plan right now for that. You have to plan right now for that. And another factor that matters here is the inflation. As we all know, the inflation is increasing. Every day, the daily, some rates are increasing. So it affects the every product, even the financial products also. So whatever you can buy from 1,000 rupees as of today, maybe you're not able to buy those many things from that 1,000 rupees 30 years later or 20 years later, or by the time you superannuate, you turn 60 years, so you won't be able to get that much things purchased out of that money that is available right now. So considering the inflation factor is also important while you plan for your retirement. Power of compounding, as we all say, you start early for retirement. That will help you in two ways. You have more time to invest, you can make more contribution, and the contribution you make got the magic of compounding also. You got your earning on your what you have already earned. You invest 100 rupees, you earn something on that. Now next time you will earn 110 rupees. So this magic of compounding make a huge fund, a huge corpus at the end of your working life that will help you to get a regular or smart income post your retirement life. There are expenses that would continue after retirement. We are like a social person. We are living in a society. So after retirement also, we all need food, cloth, and a shelter at our head. If you have a own house, you don't, worry about paying rent. In case you don't have, you have to consider for the rent also. There may be some social responsibilities also. Somebody call you for their wedding function, some housewarming functions where you have to give some expensive gifts also. Those things also will go out of your pocket. And mind it, when you are not earning or when you are not getting a good flow of income, all these matters a lot. Today maybe you are earning smartly and giving a valuable gift to some of your relative or your friend, you don't mind giving it up. But at the age of 60, when your job is not there or you have already superannuated, the regular salary is not coming to your account. So buying a valuable gift matters a lot to the person. But being a social person, we can't escape from those social responsibilities. We are a part of the society. We have to attend those function and social events even after retirement. So we need fund for those things also. And the next thing is one has to estimate the cost of your retirement goal. Once you are planning for the retirement thing, there's so many retirement products that are available in the market. So you have to see the cost of that product also, so that lesser is the cost, more is the corpus you generate out of that. So these are the broad factors that has to be kept in mind. As we discuss, what are the factors that will help you to choose the ideal retirement saving plans? As I've already told you, start early to reap the benefits of compounding on your investments. One has to choose a pension plan which is well regulated and transparent. So there is no, there are less chances of any fraud or any misleading kind of thing if it's a well regulated product. The cost, as I have just said, the cost of managing the plan. Higher is the cost, lower is the return. If lower is the cost, higher is the return, and you will make a big corpus out of that. Option for multiple investment schemes under the pension or retirement plans are available, and one has to wisely select the product according to their need and requirement. The product selected should have a good service and grievance redressal mechanism. Online and mobile app driven services offered. Today's a digital world. Nobody wants to visit any office or any bank to get something done. So the product which is, uh, very digitally form and offer you a service at the click of your mouse, or you can operate it through your phone, that tech savvy product should be chosen. Last but not the least, the product should be tech efficient as well as transparent, because you are going to invest during your working life. So whatever investment you are putting in your retirement product, that should qualify for your tax benefits also. There are few investment options for retirement planning, which we have presented here. Number one is National Pension System. It's a pension scheme with exclusive tax benefit, where the amount is invested across various investment categories like equity, debt, GSEC, corporate bonds, and alternate assets. We have Atal Pension Yojana also. It's a pension scheme for citizens of India with a focus on workers in the unorganized sector. Under APY, a guaranteed minimum pension of rupees 1,000 to 5,000 per month at the age of 60 years will be given on the basis of contribution by the subscribers. We do have a public provident fund scheme in our country. It's a long-term investment option that offers an attractive rate of interest and returns on the amount invested. There are mutual funds available. It's an investment vehicle where many investors pools their money to earn return on their capital over a period. This corpus of fund is managed by an investment professional known as fund manager or a portfolio manager. There are insurance schemes are also available that work as an investment plan with the benefit of life cover. So, how do we plan smartly for our retirement? There are four basic fundas to this. Start early as possible. Choose a well-regulated retirement scheme. Make your contribution regular to it, and do not withdraw from your pension corpus before retirement. If you tend to withdraw, obviously the saving going to be less, if the investment going to be less, the returns going to be less, and the corpus will be not sufficient to meet your requirement. So try to do that. You should make an aim that you will not withdraw from your pension corpus before your retirement. Now I will request my colleague Shri Nitin Hansda to kindly continue with the presentation. We will be now covering to the part B of the presentation, which talks about NPS and APY. Nitin.
First of all, a warm welcome to each and every participants present here. And thank you so much, Manju ma'am, for giving us insights on the various aspects related to good financial behavior, the saving, and why retirement planning has become is so important for us right now. Going forward, the things that I'll be discussing is related to the National Pension System and Atal Pension Yojana. So to start with, National Pension System is basically a defined contributory pension scheme, which was, when introduced by the Government of India, was made mandatory for the central government employees. Subsequently, it was adopted by most of the states, and now it is available for all the citizens of India on a voluntary basis. So in National Pension System, basically, an individual contributes a certain amount till a certain age, post which the amount which is being the amount which has been accumulated, it is called the retirement corpus. This retirement corpus is then used by the individual to buy an annuity from the annuity service provider, which are nothing but the life insurance companies which are registered under the Insurance Regulatory and Development Authority of India, from which the person buys an annuity, and these annuities serves as a regular monthly pension for that individual. So basically, NPS is designed to enable an individual to have adequate retirement income in the old age or upon the superannuation. So in NPS, there are various intermediaries present. We'll go through each one of them one by one. First of all, there is a point of presence. The point of presence is nothing but a distribution channel. So it's responsible for facilitating the registration for the subscribers for the NPS Tier 1 and Tier 2 account. Next one is the Central Record Keeping Agency. As the name itself suggests, it's a record keeping agency. So basically, it's a data warehouse wherein all the information related to the subscriber are stored. Currently, we are having multiple central record keeping agencies. We'll see that in later slides. Next intermediary is Trustee Bank. Basically, This is an intermediary which is the banker for the system. It is responsible for facilitating the transfer of funds across various intermediaries in the NPS. Next, we have the pension funds. So the whatever amount which are being invested by the which are being contributed by the individual, these are managed by the pension fund managers, which actually invest them as per the guidelines prescribed by the PFRDA investment guidelines. Next one, we have custodian. So custodian is an intermediary which is responsible for safeguarding the assets and securities which we have under the NPS. Next is annuity service provider. As I've already mentioned, these are the life insurance companies which are registered under the ADI and impaneled with the PFRDA, from which an individual can buy annuities, which will actually be the monthly pension post-retirement. The next one is NPS Trust. NPS trusts are basically the legal owner of the assets which are being held under the NPS on behalf of the subscribers. So these are the intermediaries present in the NPS. So now we'll see what are the features of NPS. First of all, the very important feature, it is currently being regulated by PFRD under the PFRD Act 2013. Next is it is basically a pension for all, as I already told that now NPS is available on a voluntary basis for all the citizens of India, not only the citizens, the non-residents and overseas citizens also. It is a low-cost product wherein if you compare with the other products, you can find that the cost which one incurs for subscribing an NPS is very less as compared to other financial products available in the market, retirement products. Next, it is very flexible. NPS allows a subscriber to choose from multiple options. If you'll see, there are various point of presence. Point of presence are basically, if you want to understand, is basically these are the banks or the post offices. There are multiple central record keeping agencies, multiple pension funds, and multiple investment choice options available. Next feature of NPS would be it is a portable, which means suppose if I'm currently working in this organization and tomorrow if I decides to shift from this organization to some other organization, in that case I did not require to open a separate NPS account. Whatever account, that NPS account which I have opened in this organization will continue in that organization as well. Next is it is tax efficient. As you all know, to make NPS more lucrative, it has been decided to make it tax efficient. A separate benefit under it is Income Tax Act of 80 CCD 1B. You can get a benefit of 50,000. Next is the returns are really good since it is a market linked product. So over a period of time, you'll get a good return. It is very much transparent. You can get the information anytime across 24/7. You can log into your account and you can get the details anytime and anytime you want. Next, as I already told, there are multiple options to choose from for a subscriber. Currently, for a CRA, we have 3 CRAs present. One is Protean CRA, which was earlier known as NSDL. Next one is K FinTech, and the third one is Computer Aided Management System, basically known as CAMS. When it comes to the pension funds, there are 10 pension funds available, so that a subscriber can choose as per his own convenience. And also there are multiple point of presence available. So how basically NPS works? If we'll divide the whole journey, we can see there are 3 phases in NPS. First is the entry phase, the second is the accumulation phase, and the third one is the exit phase. In the entry phase, basically NPS is meant for the subscribers aged between 18 to 70 years. And in the accumulation phase, this is the phase basically wherein you start contributing your fund. These funds get accumulated to make a retirement corpus, and in this period the funds get invested across various investment schemes by the pension fund managers as per the prescribed guidelines under the PFRDA. The last phase is the exit phase. In exit phase there are various norms. It could be like normal exit, it could be like premature exit, or it could be like partial withdrawal. We'll see the details in the later slides about the exits. So what are the account types available in NPS? Basically, there are 2 types of accounts. The first one is tier 1 account, and the second one is tier 2 account. So tier 1 account is basically your pension account. In this, there are various tax benefits available, as I already said, and partial withdrawals are also available subject to some conditions. Since it is a pension account, so the whole purpose is to make that the retirement corpus should be enough so that you can get a good pension amount post your retirement life. That's why there are restricted withdrawals in this. And contribution for tier 1 account is 500 and minimum contribution per year is rupees 1000. There are no limits on the contribution. You can contribute as many times you want and as much amount you want. For the tier 2 account, since there are restricted withdrawal and sometimes you might want to withdraw, so for that we have tier 2 account. It is basically an investment account which does not have any restrictions on withdrawal, and this can be opened only if you have tier 1 account. You cannot open separately like tier 2 account if you don't have a tier 1 account. So on a similar fashion, it does not have any limits on the contribution as well. So the point of presence, as I've already mentioned, these are basically the interface where one can get himself or herself registered for the NPS. So how to subscribe or join NPS? There are various modes available for joining an NPS. First, you can either go to your POP, the physical point of presence. You can go to your bank and ask for them that you want to register for the NPS, or as most of us now want to sit at their own place and to enjoy the benefit of technology. So for that, we have eNPS module. You can directly go to the website and just register for the NPS. It is very simple and very self-explanatory. As soon as you join the NPS, you'll get a PRAN number, which is basically a unique identification number allotted to a subscriber for his or her individual pension account opened under the NPS. This is just like a bank account number which you get once you open a bank account. In case of NPS, as soon as you open the NPS account, you'll get a permanent retirement account number. So the PRAN number remains unchanged even though the subscriber shifts, be it the employment or the sector or the location. It doesn't matter. So next is contribution or the accumulation phase. So for the contribution, you can similarly you can go to the physical. You can use the physical mode. You can either go to the point of presence and you can ask the banker to deposit your cash or check to your NPS account, or you can use the online mode, the website. You can log into your pension account and you can contribute via online mode, whether net banking or anything. So there are also SIP mode available in the NPS. Suppose if you do not want to go to the bank every time for investing in the NPS, you can just go to the bank and give them a standing instruction that which will make sure that periodic payments are made to your NPS account. Similarly, on a digital mode, you can use the day remit facility. You can log into your NPS account and you can start this monthly regular investment to your NPS account. So whatever the amount which are being contributed by the individual, these are being invested across various asset classes available through the two different modes, two different choices. One is auto choice and one is active choice. So what are these asset classes basically? First of all, the first asset class we have is equity. A maximum of 75% can be allocated in this. Next is the asset class G, which is basically the government securities. A maximum of 100% can be allocated into this. The life cycle funds, I'll be discussing it in the forthcoming slides. The next is asset class A, which is alternate asset. A maximum of 5% can be allocated to this asset. And next is asset class C, which is basically the corporate or the government bonds, corporate bonds basically, wherein a maximum of 100% can be allocated. So as I said earlier, so there are two choices available for individual. Basically, the active choice, as the name itself suggests, in active choice, the individual actively decides where he wants to put his money, and it is basically divided into these four asset classes: equity, corporate bonds, government securities, and alternate assets. The maximum permissible limit is, as I've already told, the 75% for equity. For corporate bond, it is 100%. For government securities, it is again 100%, and for alternate investments, it is 5%. Suppose, as most of us are not so aware of the investment pattern, and as we not so much informed about where we should invest our money. So there's another facility available called the auto choice. It is basically a life cycle fund in which if I want to invest more aggressively, or if I'm young and if I want to get the better returns, if I can take risk, I will choose the aggressive life cycle fund where the equity exposure is 75, a maximum of 75%, which gradually decreases over a period of time. Similarly, if I want to choose a hybrid of kind of fund wherein there should be a mixture of both equity and corporate and government, so I'll choose the moderate life cycle fund, which is basically the default fund, in which the maximum permissible limit for the equity is 50%. Similarly, if I'm on a later stage of my life, suppose if I'm 40 or 45, during that stage, I would not like to go for a higher riskier option. So I'll choose for a safe. I'll go for a safer side. So that is the life cycle fund 25. Basically, the equity exposure in this is 25%. From this chart, you can see the equity exposure at the initial stage of investment. At every stage is on a higher note, but gradually this shifts to the on a safer side as you grow older. So in the aggressive life cycle fund, you can see the asset class E, basically the equity, the exposure is 75% at the age of 35, which gradually decreases to 15% at the age of 55, and the exposure to the government securities becomes 75%. Similarly, for other life cycle funds also, the exposure going forward is more inclined towards the government securities. Next is the withdrawals. Suppose if you want to withdraw partially in NPS, so there's an option available for that also, but it is available with certain conditions and certain restrictions. So what are these conditions? First of all, a subscriber should be in NPS for 3 years. You cannot withdraw if you are a part of NPS for less than 3 years. Next, the amount should not exceed the 25% of the contributions made by the subscriber. So you can only withdraw the 25% of your own contribution, not even the contributions made by your employer. Second thing is, there are various purposes for which the partial withdrawal is allowed. Once mentioned are some of the purposes. The first one is for higher education for children. Next is marriage for children. Next is purchase or construction of resident house or flat. And next is treatment for specified illness. If you become disabled and that disability is more than 75%. If any self-development activity is required, or if you are starting your own venture or any startup. So these are some purposes for which the partial withdrawal is allowed. Next is the frequency. A maximum of 3 times during the entire period of your NPS life, you can withdraw partially, not more than that. The next comes is the normal exit. Suppose everything goes well and at the age of superannuation or the 60, you want to take out the money. First of all, you can do it by requesting online or offline. And a maximum of 60% of your total retirement corpus can be withdrawn as the lump sum. Rest 40%, you have to buy it mandatorily for purchasing the annuity. Or else, if you want, you can, if you don't need the money at the time of your retirement, you can convert the 100% of your retirement corpus to buy the annuity, which will make sure that the pension amount that you'll get after your retirement is good enough to take care of your retirement life. And one more thing, if the retirement corpus is less than 5 lakh, you need not require to purchase any annuity. You can directly withdraw the whole 5 lakh to your saving banks account. Next, the withdrawals are tax free, and the monthly pension that you'll be receiving after buying an annuity is taxable as per the income tax slab. Next is premature exit. Suppose if there's an urgency and there's a requirement of premature exit, that is also can be done, but that is not advisable actually. That can be done via online or offline mode. If you decide to withdraw, if you decide to do the premature exit, the condition is 20% of the total corpus. Only 20% of the total corpus can be withdrawn as a lump sum, and rest 80% will be used for the buying an annuity. If you do not need that 20% as a lump sum, the whole 100% can be used to buy the annuity. And if the retirement corpus is less than 2.5 lakhs, then the whole amount can be withdrawn without purchasing the annuities. What if the person dies? So in case of government employees, it is similar, like you have it 20% of the corpus can be withdrawn and 80% will have to be purchased for the annuity by the nominees. In case of the all citizen model, the whole amount which are being invested in the NPS, that can be withdrawn as a lump sum for the by the legal nominee or the heirs in case of the all citizen model. So there are some facts in for NPS, like a maximum of 3 nominees can be appointed in NPS, and a specific different percentage can be given to all these nominees. Next, suppose if you are not in a dire need of money at the age of 60, which is your superannuation age, which can be your superannuation age, so you can continue investing in NPS till the age of 75, and you can get the benefit of compounding. Post the age of 75, you can buy your annuity from the annuity service provider, which will give you the monthly pension. So tier 2 withdrawal, basically tier 2 withdrawal is permitted at any point of time without any restrictions. Transferring of fund from tier 2 account to tier 1 account, it's a one-way switch possible, not the other way around. You cannot transfer fund from tier 1 to tier 2. In case of closure of NPS tier 1 account, the pension account, the tier 2 account automatically gets closed, and the amount can be withdrawn automatically to your savings bank account. Tier 2 withdrawal can be made online by visiting the POPSP. Now, I've been mentioning about the annuities since very long, that a person buys an annuity post-retirement. So what exactly is annuity? This is a special type of insurance contract under which periodic payments are made against your retirement corpus. And these annuities generate a regular income over a long period of time on investment of a retirement corpus amount. The individual or the holder of the annuity can decide the mode of annuity payment, basically when he wants to get the annuity or when he wants to get the pension amount. It can be the immediate annuity, like if I decide to buy the annuity today, I can get the pension from the very next month, or I can choose for the deferred annuity, wherein I can get the pension amount after a certain period of time. So there are certain annuity plans available with the various annuity service providers. This you can get online also. So the first one is the, if I say a few of them, the first one would be annuity for life. In this, the pension that you'll get after the retirement will be till the time you will be alive. Next is the annuity for life with the return of purchase price. In this, the amount will be payable, the pension will be payable to you till the time you are alive. Post death, you'll get the amount which you have invested in buying the annuity. That amount will also be returned to your nominee. On a similar fashion, there are multiple annuities available. These are available on the life insurance company's website also, so you can refer to that. Next is the factors impacting annuity. There are multiple factors which actually impact your annuity, basically the pension. First of all, the NPS corpus. If the amount is very small, then obviously the pension amount which you will be getting after buying the annuity will be really less. So it is advisable that you should regularly contribute to your NPS account, so that the amount which you will get as a retirement corpus will be good enough, so that you can buy the annuity and you can get the benefit of a good pension amount. It is also based on the annuity service provider. As I've already told, as I've already said, there are multiple annuity service providers empaneled with us. Currently, these are 14 in numbers, 14. So different annuity service providers provide their different rates. So this also impacts the amount of annuity. On a similar fashion, it depends on the type of annuity that you are choosing, whether I'm covering for myself or whether I'm choosing for my spouse also. So in that, obviously the amount will get reduced, the pension amount, if I'm covering me and my spouse. If I decide to get the money which I've chose to buy the annuity, if I want that money back, then also the amount of pension will get reduced. So these are certain factors which are responsible for impacting the annuity. So what are the tax benefits and implications available in the NPS? As I already mentioned, there's an exclusive tax benefit available under section 80 CCD 1B, wherein you can get the benefit of 50,000. Also, the 60% of the total corpus amount at the time of exit is not treated as income, hence it is non-taxable. The amount utilized for the purchase of annuity at the time of exit, which is a minimum of 40%, that is also not treated as income, hence it is also not taxable. The partial withdrawals are also tax exempted. Now we will see the grievance redressal mechanism. This is very important for any product. Like, there should be a proper grievance redressal mechanism. So a subscriber having whatsoever grievances can raise his or her grievance to a concerned intermediary within a time limit of 30 days, post which the same can be escalated to NPS trust. The timeline is again 30 days. If not resolved, the same can be escalated to the ombudsman. The timeline for that is 90 days. If again the subscriber is not satisfied, then the same can be escalated to the authority within 30 days. The authority, that is PFRDA. If not satisfied, then the lender then the last resort would be to go for the Security Appellate Tribunal, that is SAT, which will give the ultimate final decision. So these are the things which comes under the NPS. Given the fact that we have a limited time, so we have tried to incorporate as much as we could in this NPS, in this presentation. So we'll see the Atal Pension Yojana. Basically, the Atal Pension Yojana, it is meant for the unorganized sector, which are which do not have so much of income. So this is basically, earlier it was meant for all the citizens of India, but from 1st of October 2022, it was decided to make it available for the non-income taxpayers between the age of 18 to 40 years, and these they can join the Atal Pension Yojana through the bank or Department of Post. It is very simple. You can directly go to the bank and you can just fill a single page form and you can get the APY account. So post 60 years of age, you can get the pension from 1,000 to 5,000 per month. So it is basically 1,000, 2,000, 3,000, 4,000, and 5,000, depending on the contribution that you are doing. So the accumulation, you can do the monthly contribution, quarterly or half yearly contribution to your bank account, to your APY account basically. And the pension amount opted and the frequency may be changed to a higher or lower amount once a year. How to join the NPS or how to subscribe the how to join the APY or subscribe the APY? Basically, there are various modes available. You can the physical mode, you can either go to the bank or the Department of Post, wherein you can just fill the form, single page form, and you can get yourself enrolled to the APY, or you can just sit back at your place and you can log into your net banking, whatever bank account you have. There's also a facility available in that net banking wherein you can directly subscribe to your APY account, or there is an e-APY facility available wherein you can join the APY. So the Atal Pension Yojana is designed in such a way that it has got triple benefit. First of all, a minimum guaranteed pension you'll get post your retirement, basically post 60 years, which is 1,000 to 5,000. And the same pension is payable to the spouse after the death of the subscriber. Basically, if the subscriber dies, then the same pension amount will be received by the spouse. The return of the indicative pension wealth to the nominees after the death of the spouse. So whatever the corpus can be returned to the nominees post the death of this subscriber or the spouse. So these are the triple benefits under the APY. So APY has got very user-friendly features. We've also done a lot of work for developing the APY app, which is very user-friendly. Once you'll download the APY app, you can get all the details in that APY app. You need not require to go anywhere else, be it the enrollment or be it the exit or whatever the statement you want to see. Anything can be done through that APY app. So these are the overall features currently available under the APY. You can see there is a mobile application, there is an internet banking facilities available. Subscriber can exit at any point of time. SMS facilities also there, and a lot of features are there. You can see. So for exit in APY, suppose a person dies before the age of 60, the amount of accumulated corpus in the APY account will be paid to the spouse. The spouse also has an option to continue the APY account post death of the subscriber. If the subscriber wants to prematurely exit the APY account, that can also be done. The accumulated corpus, including the subscriber contribution and the returns, will be paid to the subscriber after deducting the charges of the charges and the government's co-contribution, if any. So in APY also, there's a proper grievance redressal mechanism available. You can log into your CRA website and you can lodge your grievance. So you can get your grievance resolved through the CRA website. So so the journey of PFRDA and the NPS and APY, the total asset under management, as you can all see, it was it was in 31st January 2022, it was around 7,05,806 crores, which as on 31st of January 2023 has reached to an amount of 8,65,029 crore rupees. So the growth is around 22%. The number of subscribers has also increased over a period of time. You can see the as on 31st of March 2020, it was around 345 crores. Now, 3.45 crores. Basically, the amount, the numbers are in lakhs. So 3.45 crores were the subscribers as on 31st of March 2020. Now the number of subscribers have increased to 6.18 crores. So you can see the number of subscribers have gradually increased. Recent developments under PFRDA, basically to ensure that financial literacy is a part, and we have a pension literate society. We have taken various initiatives under the PFRDA and Financial Literacy Department. We have started training to NPS and APY subscribers, and we also take various awareness programs across pan-India level, wherein the officers from PFRDA goes to various states and conducts the literacy programs. There's a dedicated financial literacy website called the Pension Sanchay, wherein one can read various articles and get themselves enriched with the knowledge related to financial literacy. Next is NPS Ki Pathshala, a video series available on the official YouTube channel of NPS, wherein you can get the information related to NPS in a video mode. And last but not the least, the retirement planner scheme, which have recently been launched, that is last year, through which we have empaneled the retirement planners, which actually go to the ground level and to the tier 2 or tier 2 cities and try to disseminate the financial literacy among the common public. So these are some of the recent developments under the PFRD financial literacy. PFRD is also present across various social media platforms. In Twitter, you can see there's in Twitter, LinkedIn, Facebook, and YouTube. So PFRD is also there. So that's all for the NPS and APY. If you have any question and answer related to whatsoever things which we have discussed in this session, you can ask us. So we'll try to resolve your query as much as possible. So if you want, you can ask.
Participants, you can ask the questions in the chat box, or otherwise you can request to unmute you in the chat box. I will unmute you. Mr. Ram Prasad Murthy is asking, is there a ceiling an individual has for the number of NPS accounts?
Number of NPS account can only be one.
Okay. And Mr. Anil Kumar Jaladi is asking, does the individual eligible for NPS and APY scheme at a time?
Yes, sure. You can apply for both the scheme at a time, not an issue.
Mr. Indrani Mato is asking, what happens to annuity corpus after death?
After?
Death.
the annuity will be paid to your nominee or the spouse, whosoever is your nominee. The annuity corpus will be paid to them.
Mr. Viresh Pratap Yadav is asking, what is the rate of interest if surrender APY?
Sorry?
What is the rate of interest if surrender APY?
Exactly the rate of interest we'll have to see. You can for that you can mail to us. We'll get back to you for the rate of interest for the APY. It is around 7 to 8%, around maybe.
Okay. Mr. Tejeshwara HM is asking whether we can change the APY pension rupees 1,000 to 5,000. What we can do?
You can change it. That can be done once a year. Suppose if at the age of 18 I join the APY account, then my retirement, then the investment contribution would be around 42. You can go to your POP or you can online also, and you can request for increasing the amount. I don't know the exact amount for the 5,000. You can increase. You can ask them to increase the amount. It can be done online or by visiting the POP. But that can be done once a year.
Yes. Rajiv Jain, sir, you can ask your question. I have unmuted you.
Okay, thank you very much. I am Rajiv Jain from Saranpur. My question is, a friend of mine, he has contributed for 6 years in the NPS.
Okay.
Hello, am I audible?
Yes, please continue.
And he is now around 64 years of age. His corpus is around 4 lakh rupees, including, the interest.
Okay.
So can he withdraw the entire amount or does he continue up to 70 years of age?
So first of all, my question would be, to which sector your friend belongs, whether government employee or corporate or all citizen not?
He was a government teacher. He started at the age of 58.
Okay.
So, but he is not depositing. He's not accepting any government contribution in that. It is all his own contribution at the rate of 50,000 rupees per year.
Okay, so basically, I think as per your instructions, I can understand. I think he has chosen for the all citizen model since there is no government contribution. So for that, it depends on that person whether he wants to continue. He can continue till the age of 75. If he is not in a need of that amount, he can continue till the age of 75. Suppose if he wants to withdraw, he can withdraw right now also. And since the amount is less than 5 lakh, the whole amount can be withdrawn.
All right. Thank you very much. Second question is, suppose in one of the last presentations that I had attended from PFRDA, there was a mention of the amount of APY being increased from 5,000 to 10,000 rupees per head. Is such a decision coming through or?
Not yet.
Not yet, sir. Not yet.
All right. Thank you very much. Thank you so much.
Okay. Shall we take 1-2 more questions or shall we wind up, madam?
We can take 1 or 2.
You can take. If some questions
Okay.
are there, we are ready to answer. No problem.
Okay. Mr. Uday Kumar is asking, can we close NPS on retirement with amount rupees 4.5 lakh and reopen another time later on?
Yeah, sure. You can anytime open or close between the age of 18 to 70 years. Suppose if I've opened the NPS account at the age of 30, so my normal superannuation age will be 60, and during that time I've exited the NPS account. Now again, suppose if I want to join the NPS at the age of 65, I can again join the NPS.
That will be a new account.
Okay. Mr. Ziaul Haq is asking, in case of exit, you said that only subscriber contribution is given. May I know what type of increment is given in that contribution?
No, that is for partial withdrawal, not the exit. In the partial withdrawal, only the 25% of the subscriber contribution you can withdraw. In exit, that is not the case. The returns will also be paid to the subscriber.
Mr. Subrajit Roy is asking, in APY scheme, who will get the pension after spouse death?
The government will pay you the pension. Can you please repeat your question, the last question?
The question is like, in APY scheme, who will get the pension after
Acha.
spouse?
Okay, who will get the pension after this? Your spouse. I mean, suppose if I die after the, suppose if I die, then my wife will get the pension.
If the wife dies.
Acha, then the nominees will get the pension.
Yes, no. Then Viresh Pratap Yadav ji is asking, after retirement, a NPS holder received money are taxable or not?
Sorry, can you please come again?
Retirement, a NPS holder received money are taxable or not?
The 60% amount which you'll receive as a lump sum is not taxable, and the 40% amount which will use for buying the annuity, that is also not taxable. The only taxable thing here is the pension which you'll get after buying the annuity.
Okay. Sushma Das madam is asking, you mentioned NRI can also join the NPS. Can you please elaborate?
Yes, NRIs can join the NPS, not an issue.
She's asking to elaborate it.
Elaborate as in you can check the online. I mean, there are certain documents for the NRI just to clarify whether you are NRI or not. So every other things remains the same.
You have to do the whole procedure the same way. The
Just the KYC would be different. Since you are NRI, the KYC would be different. That's it.
KYC requirements has to be fulfilled. You have to fill the form. You can use the e-platform also for joining.
Just everything remains same. The
Yes.
condition and everything remains the same.
Okay. We'll take one final question. Can a nominee enjoy two pensions, one from his or her own contribution and other from the contribution made by him, the case partner account?
That we'll have to see. You can write mail for that. We'll get back to you for this question.
Okay, Agil Singalji, you can write an email to us. We will forward that to PF.
Yes, please.
Okay, I think we can wind up the session. Right, madam? If you want to add anything.
I just want to add something here. As we all see that the retirement plan helps us to create a regular flow of income after retirement. So accordingly, for smart retirement, we should start early, build a retirement corpus through market-linked returns. There should be a regular and guaranteed income, and regular contribution should be made to the retirement savings. See, one of the greatest reward of life lived well is the peace of mind in your golden years. So now that we all are aware of smart retirement, we should start planning and investing for the life of our dreams post-retirement. When we are planning our retirement, it is important to consider both the financial as well as non-financial aspect of this important life stage. As we all know, retirement can be a decade-long journey, so it is important to be prepared both financially as well as emotionally for this. I would like to take this opportunity to thank NCFE for giving us this opportunity to talk about the smart retirement. And we would also like to thank all participants who have attended the session. For any further detail, one can reach us through our website as well as social media platform that we have already shared. Thank you so much. Thanks.
Ma'am,
I request Mr. Viraj Khare.
Can I ask one last question, ma'am?
Sorry?
Can I ask one last question, please?
Yeah, please go ahead.
Ma'am, if this amount is less than 5 lakhs and we are doing a premature withdrawal, will this amount be taxable?
No.
All right. Thank you very much. Thank you so much.
Okay, now I request Mr. Viraj Khare to deliver the vote of thanks.
Thank you, Midun. Thank you, Midun. So my name is Viraj Hare, AM NCFE. I'm fortunate for giving vote of thanks for today's prestigious session of Financial Literacy Week. And I must say that it was indeed a very informative session, and we all have gained deep insights about today's topic, that is good financial behavior for smart retirement, which is very essential. So on behalf of my entire team at NCFE, I would like to extend my sincere thanks to respected Manju Bhalla ma'am, GM PFRDA. Thank you, ma'am. And Shri Nitin Hansda sir, AM PFRDA. Thank you, sir. for blessing this today's session with your presence and delivering such a wonderful session. I really thank you. Thank both of you, and we expect a lot more sessions from your side. Thank you. And I would also like to convey my sincere thanks to all the resource persons, SEBI Smart trainers, financial education trainers, pension trainers who are connected with us and also participated in today's capacity building program. Thank you all for being connected with us. And lastly, I would request all the participants to connect with us tomorrow also for as we will be observing Digital Financial Services Day, and it will be our last session of this series of capacity building program during Financial Literacy Week. So I expect the same enthusiasm for tomorrow as well. Thank you all for being here for today's event, and we can conclude this session and have a great day. Thank you.
Thank you. Thank you so much, Viraji. Thanks a lot.
Thank you.